When a bank closes your business account, the closure notice feels like the end of the conversation. It is not. There are concrete steps that can change the outcome, but only if you take them in the right order and understand what is realistically reversible and what is not. Step 1 is to protect your operations before you fight anything. A closure usually comes with a notice period, and the money does not vanish, but your access to it may be restricted, and your incoming and outgoing payments will be disrupted. Before anything else, redirect critical payments, notify the people who pay you, and make sure payroll and essential obligations have an alternate path. Fighting the closure matters less than keeping the business running while you do it. Step 2 is to read the notice for what it actually says, and does not say. Most closure notices give a generic reason, or no reason at all. Note the effective date, the notice period, and any stated process for questions or appeals. This document defines your timeline and is the reference point for everything that follows. Step 3 is to reach the right function inside the bank. The general customer service line cannot reverse a closure, and usually cannot even see why it happened. The closure came from compliance or risk management, and that is the function you need. Ask to be escalated to the department that handles account closures or risk decisions, or work through a branch manager with escalation authority. Reaching the right people is the step most account holders never clear. Step 4 is to ask the 2 questions that produce information rather than reassurance. What, if anything, can I provide that would lead the bank to reconsider this decision? And is there a formal review or appeal process for this closure? These questions position you as cooperative and surface whether reconsideration is even possible. Step 5 is to understand what is realistically reversible. Closures driven by an operational or relationship issue are sometimes reconsidered when you provide context the bank was missing. Closures driven by a compliance determination, especially anything connected to a suspicious activity filing, usually cannot be reversed, and the bank is often legally prohibited from explaining why. Knowing which kind you are facing tells you whether to fight for reversal or pivot to protecting your record and securing a new relationship. Step 6, if the closure holds, is to limit the damage. Make sure you recover all remaining funds, get written confirmation of the closure, and understand how the bank reported it, because that report affects your next application. A closure you cannot reverse does not have to become a closure that follows you, but only if you manage the record it leaves behind. The honest reality is that not every closure can be undone. But responding in this order protects your business whether the closure is reversed or not, and that is the outcome most within your control.